Gold just smashed through $3,800 an ounce, hitting a new all-time high of around $3,820. It's one of the biggest moves in precious metals history, leaving investors worldwide asking, how did gold get here so fast, and where could it go next? With U.S. interest rate cuts on the horizon, inflation running hotter than many expected, and even a possible government shutdown looming, gold has become the market's ultimate safe haven star. Today, we'll dive deep into the forces behind this historic rally, the risks ahead, and the critical levels everyone is watching. Gold's unstoppable rally. In late September 2025, gold broke past the monumental $3,800 barrier, reaching as high as $3,820 per ounce before easing slightly toward $3,810 per ounce. This milestone represents not just another record, but the culmination of powerful global forces reshaping financial markets. Year-to-date, gold has gained an astonishing 47%, massively outperforming traditional benchmarks. Bitcoin, the S&P 500, and even other commodities have all lagged behind. In other words, gold has reclaimed its position as the top-performing major asset of 2025. The scale of this rally has left many wondering whether gold has entered a new supercycle or whether the metal is due for a sharp correction. To understand that, we need to explore the drivers. Why gold is soaring? Several interlocking factors are fueling this rally. Let's break them down clearly. Federal Reserve and lower interest rates. The U.S. Federal Reserve has shifted decisively toward rate cuts. Markets now expect multiple cuts in the coming quarters. This matters because gold doesn't pay interest. So when Treasury yields fall, the opportunity cost of holding gold also drops. That makes it far more attractive compared to bonds or savings accounts. Sticky inflation. While inflation has cooled from its peaks, it remains stubbornly high. Core PCE inflation, one of the Fed's preferred gauges, is hovering around 2.9%, above the 2% target. This keeps gold attractive as a hedge because people and institutions turn to precious metals to protect against eroding purchasing power. Central bank buying. Central banks around the globe, from the United States and China to Russia and Turkey, are aggressively adding gold to their reserves. This structural demand acts like a safety net under prices. When nations stockpile gold, they remove it from the market, tightening conditions and pushing values higher. Weakening U.S. dollar. The dollar has slipped by nearly 10% year-to-date. Since gold is priced in dollars, a weaker greenback makes the metal cheaper for buyers using other currencies, boosting global demand. Historically, a falling dollar and rising gold prices move hand in hand. Geopolitical and political risks. From ongoing tensions abroad to the looming risk of a U.S. government shutdown, uncertainty is running high. Investors typically seek safe havens during such times, and gold remains the most trusted refuge. Together, these forces form the backbone of gold's unstoppable 2025 rally. Technical picture and market momentum. From a technical perspective, gold is clearly in overbought territory. Momentum indicators like the RSI show stretched conditions. Normally, that would suggest risk of a correction or sideways pause. Key levels stand out. Immediate resistance sits around $3,820, the fresh all-time high. Immediate support rests near $3,750 to $3,736. If gold holds above those zones, the uptrend remains intact. A break below could trigger retracements toward $3,700 or even $3,650. For now, momentum remains strong. Buyers have repeatedly stepped in to defend dips, signaling confidence that the rally has more room to run. Still, these stretch technicals mean any shift in narrative, stronger dollar, hawkish Fed comments, or easing geopolitical risks could spark volatility.
The government shutdown factor. One unique catalyst dominating headlines right now is the potential U.S. government shutdown. If Congress fails to pass funding measures, the shutdown would raise concerns about fiscal stability and economic disruption. Historically, such events erode confidence in U.S. assets and the dollar while boosting gold. In fact, part of gold's latest push to $3,820 came directly from this narrative. As traders priced in the possibility of a shutdown, they rotated into safe havens. Even if the shutdown is avoided, the political uncertainty surrounding it continues to provide support. Fed policy and market psychology. The Federal Reserve's outlook remains central. Investors firmly believe rate cuts are coming, perhaps sooner than policymakers had initially planned. This belief has anchored gold's bullish case. Every dovish remark from Fed officials reinforces the momentum, while any sign of hesitation sparks brief pullbacks. Market psychology is powerful here. Gold isn't just trading on fundamentals, it's trading on sentiment. The narrative that the Fed is easing, the dollar is falling, and risks are rising has created a self-reinforcing cycle. Until that narrative breaks, the trend may continue. Risks that could trigger a pullback. While the backdrop is bullish, no rally is without risk. Several potential triggers could cause a correction. A stronger US dollar? If the dollar stages a rebound, gold could lose shine quickly. Hotter US data, strong labor market, or inflation reports could push the Fed to delay cuts, hurting gold's case. Profit taking. With prices so elevated, some investors may lock in gains, leading to sharp pullbacks. Technical exhaustion. Overbought signals may spark algorithmic selling or consolidation phases. Any of these could cause gold to retreat toward lower support levels, though the overall long-term uptrend would likely remain intact. Silver and other precious metals. Gold's rally has also drawn attention to silver. Often referred to as the poor man's gold, silver tends to follow gold's lead but with sharper percentage swings. Several of the Dow Jones bulletins highlighted silver's movement, suggesting traders are monitoring both metals closely. A strong gold market often spills over into silver demand, though silver carries its own supply-demand dynamics tied to industrial use. So where does this leave us? Gold is at record highs, fueled by Fed policy expectations, sticky inflation, global central bank buying, a weaker dollar, and mounting risks in U.S. politics and geopolitics. The rally has been fast and powerful, raising the odds of a pullback, but no clear reversal signals have appeared yet. Technical levels around 3820, 3750, and 3700 will be closely watched in the coming days. Market psychology remains strongly bullish, with gold seen as the safest safe haven in uncertain times. What to watch going forward? Looking ahead, the following developments will be critical. Federal Reserve statements, will they confirm or push back against market expectations for rate cuts? U.S. economic data. Inflation and jobs reports will directly impact policy outlook and gold prices. Dollar performance, any major rebound in the greenback could pressure gold. Political risks, the government shutdown saga and broader global tensions remain wildcards. Central bank activity, continued buying from global institutions will provide structural support. Gold has entered a historic phase, breaking into uncharted territory above 3,800. Its rally reflects more than just investor enthusiasm. It's the result of deep structural forces in the global economy. Whether gold continues its march upward or pauses for breath will depend on how these forces evolve in the weeks ahead. For now, one thing is clear. In 2025, gold is the asset everyone is watching. This video is for informational and educational purposes only. It is not financial advice and should not be taken as a recommendation to buy, sell, or trade any asset. Markets are volatile and conditions can change rapidly. Always do your own research and consult with a licensed professional before making financial decisions.